Hello and welcome to the Forma Models e-commerce business plan financial model walkthrough. This model can be used to prepare and analyze a startup or existing e-commerce business plan forecast that incorporates a pre-sale launch period, regardless of industry, using a three-statement model and key industry agnostic metrics. The monthly Pro Forma tab includes all assumption inputs as well as the calculations for the income statement, balance sheet, and statement of cash flows. The model is dynamic for up to a 5-year forecast period and allows for a variety of debt and equity assumptions, including the ability to buy back or issue debt and equity throughout the business hold period. The Output tab provides print-ready formatted reports of key metrics and indicators, which can be used with investors and lenders as an investment and business plan supplement. The README tab states the model purpose, highlights common use cases, and provides an overview of functionality, formatting, and all of the unique modules within the model. This tab also provides additional documentation, contact information, and a summary of additional products and services available from Forma Models to support your analysis needs. The General Assumptions section has 3 date inputs. The first date input is for the landing page launch. The second date input is for the pre-sales launch. This is to be used if you are planning a pre-sale period before fully launching operations and order fulfillment. The third and final date input is for the operating launch, which is the start date of full business operations. The Partnership Assumptions section contains inputs for up to 5 common equity partners. Pro rata ownership percentage inputs by partner are input as the assumptions. The Startup Valuation Assumptions is pre-formatted for 2 equity rounds, one for the pre-launch valuation and capital call, and one for the operating launch valuation and capital call. The pre-launch valuation is equal to the capital required for landing page hosting, marketing, and other overhead costs. The operating launch valuation is a larger financing round that incorporates capital expenses, working capital, and financing for current assets. A loan-to-value input is available for both financing rounds to calculate the equity and debt funding. This model is robust and pre-programmed for the use of long-term debt as well as a line of credit to cover operating shortfalls. The next section contains the exit valuation assumptions inputs, including the earnings before interest, taxes, depreciation, and amortization exit multiple, as well as an estimate of closing costs as a percentage of the disposition value. The e-commerce business plan model comes with a pre-programmed revenue forecast driven off the estimated number of monthly sales and average order value per sale. Please reach out if you require a different revenue model, as Forma Models has a variety of pre-programmed revenue forecasts and also completed affordable custom financial model engagements. The cost of goods sold as a percentage of revenue is entered next. As a reminder, cost of goods sold is deducted from revenue to calculate the gross margin. Payroll expenses can make up a substantial portion of operating expenses. Due to their large expense burden, corporations at times will employ dynamic staffing models with staff working seasonally or only hiring people once certain metrics, such as a sales or profit target, are met. The Forma Models business plan has a complex and dynamic payroll module allowing for a variety of different staffing programs. The position name is entered in column B. The start date of employment is entered in column C. The number entered in the column relates to the model month number. For example, month 1 will be the first month of the model and month 12 will be the 12th month of the model. If you want a position's employment to begin in the first month of the forecast, enter 1 as the start month. The end date of employment for model purposes is entered in column D. Similar to the start month, the end month relates to the model month number. For example, if you want to model an employee for the entire 5-year analysis period, enter the end month as 60. If you wanted to hire a position for a project in year 3, but won't need the position beyond year 3, you can enter the start month as 25 and the end month as 36. Payroll burden is for overhead related to payroll expenses, such as payroll taxes and benefits. The payroll burden figure is entered in cell F30. An annual payroll inflation assumption is entered in F31 to account for annual labor expense growth. If applicable, vehicle expenses are entered next following the same format as the payroll schedule. If vehicle expenses are not applicable to your business, please skip this section of assumptions. Facility expense assumptions are entered next, which include rent, property tax, property insurance, utilities, as well as repairs and maintenance expenses. Selling, general, and administrative expense assumptions are entered next. Preloaded model assumption line items include delivery, advertising, and administrative costs. Some of the expenses, such as delivery and advertising costs, are input as a percentage of revenue, while other expenses, such as insurance, are entered as a flat monthly dollar amount. This section also includes the corporate income tax rate assumption that will be applicable to your use case. With these assumptions completed, the income statement will begin populating in a neatly organized and logical format. Cost of goods sold are deducted from revenue to calculate the gross profit and gross profit margin. Gross profit is followed by operating expenses. You may notice that owner compensation, including salaries, benefits, and vehicle allowance, are isolated. Total operating expenses are consolidated and then deducted from gross profit to generate the monthly earnings before interest, taxes, depreciation, and amortization. The monthly earnings before interest, taxes, depreciation, and amortization is complemented by a calculation of the monthly earnings before interest, taxes, depreciation, and amortization margin. The earnings before interest, taxes, depreciation, and amortization is followed by depreciation and amortization deductions. Depreciation expenses are deducted to calculate the monthly earnings before interest and taxes. A calculation of the earnings before interest and taxes margin is also included within the income statement. Interest expenses are separated by term debt and line of credit and deducted from the earnings before interest and taxes to determine the earnings before taxes. Taxes are then deducted to determine the monthly net earnings and net margin. It is now time to input the balance sheet assumptions. The days of sales outstanding, used to calculate accounts receivables, and the days of payables outstanding, used to calculate accounts payable are entered next. These are key inputs that impact the balance sheet as well as working capital, which impacts the statement of cash flows. The next section of the model calculates and summarized the monthly depreciation expense for capital assets. The depreciable asset schedule handles inputs as the item label in column B, the date of acquisition in column C, the expense in column D, the number of months to depreciate the expense over in column E. The columns to the right calculate the monthly depreciation by item depending on the applicable months of depreciation you input for the specific item. At this stage in the modeling process, the balance sheet will begin to populate. Please note that Pro Forma Models never utilizes plugs within our financial models. This means that all items flow through each of the three statements through the use of supporting schedules rather than utilizing accounts to force balance the statements. This leads to enhanced accuracy and credibility. The balance sheet models assets split into current and non-current assets. Liabilities are also modeled as current and non-current liabilities and includes any applicable debt used as part of the transaction you are analyzing. The balance sheet concludes with the equity accounts. Following the accounting equation that assets need to be equal to liabilities plus shareholders' equity, a check is worked into the balance sheet to ensure the accounting equation holds true. The next section in the model contains the line of credit and long-term debt forecast. The line of credit is used to fund any operating cash shortfalls and includes an assumption for a minimum liquidity metric. To model the line of credit, we begin by entering the percentage of accounts receivable to be financed in cell F136 and the percentage of accounts payable to be financed in cell F137. If you desire to include a minimum liquidity threshold, the value can be entered in cell F142. The calculations will automatically determine how much will be drawn on the line of credit. The monthly amount will be displayed in row 144. The benchmark interest rate can be entered in row 146, and if your debt has a spread, it can be entered in row 147. The long-term debt section is used to forecast financing used for long-term assets, such as acquisitions and capital expenses. The monthly principal payment you will make can be entered in cell F154. If you desire to make additional monthly prepayments on the loan, the value you desire to prepay can be entered in row 157. The calculations in row 165 to 167 calculate the total monthly interest payable on both the line of credit and any applicable term debt. A cash flow statement is presented next, which begins with a calculation of the monthly changes in net working capital. The cash flow statement is organized in an industry standard format with cash flows broken out by operating, investing, and financing activities. The cash flow statement concludes with a calculation of the monthly incremental cash flow as well as the monthly beginning and ending cash balance. This is incredibly useful for risk management, understanding run rate, and the ability to invest further in the business or pay down debt. Key metrics from the income statement and balance sheet are presented on a monthly basis. Key metrics from the income statement include the earnings before interest, taxes, depreciation, and amortization margin, net income margin, effective tax rate, and interest coverage ratio. Balance sheet metrics include the working capital balance, current ratio, quick ratio, debt to equity, debt to assets, and return on equity. The gross levered returns are presented next, including the calculation of monthly net cash flow, yield, internal rate of return, and multiple of capital. The Output tab contains the preformatted executive summary with visualizations of your analysis. This tab can serve as a useful report with equity and debt investors as well as a business plan supplement. The first chart shows the annual aggregate customer revenue as well as an annual tracking of customer sales growth. The next section of the output report contains two visualizations. The annual revenue, cost of goods sold, and gross profit is on the left, and an annual tracking of revenue and revenue growth is on the right. The final section of the output report provides a visualization of the annual operating expenses and expense growth on the left and a visualization of key margins by year on the right. Thank you for tuning in. We hope you enjoyed this Forma Models walkthrough and encourage you to visit our website to try the model for yourself.